Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are analyzing two articles. The first article we're going to be analyzing is titled, An IPO Pro Exits Airbnb and Palantir. It bought Robinhood and Rivian. After that, we're going to be analyzing another article titled, This Super Artificial Intelligence AI Stock Has Surged 20% in 2024 already. Here's why it is still a screaming buy. So for more videos just like this one, go ahead and annihilate that like button right now. Subscribe if you are new. Comment your thoughts down below about any or all of these stories. And with that being said, let's get right into it. Recently, a firm that specializes in IPO and DPO research made some major moves that you need to be aware of. This company made two very high-profile investments by selling two companies, which would be Palantir and Airbnb, and they used the profits from this to buy Rivian and Robinhood. If you're not familiar, Airbnb is a short-term rental firm, while Palantir Technologies is a big data and analytics company which serves both commercial enterprises as well as government agencies. On the other end, we have Robinhood Markets, which is a brokerage account which allows you to buy, sell, and trade cryptocurrencies as well as stocks. But we also have electric vehicle maker Rivian. Now, the interesting about this is that Renaissance Capital LLC sold their shares in Airbnb and Palantir and used these funds to buy Robinhood and Rivian. But why would they do this? In my opinion, Airbnb and Palantir are better stocks and companies than Robinhood and Rivian Automotive. But Renaissance believes that Palantir and Airbnb could be overvalued while Robinhood and Rivian are undervalued. But don't take my word for it, because we have Matt Kennedy, which is a senior strategist at Renaissance Capital, and he said, and I quote, "We sold Airbnb and Palantir in our fourth quarter rebalance because by that point they had been publicly traded for more than 3 years. The Renaissance IPO exchange traded fund is designed to hold unseasoned equities not found in many core portfolios." So essentially they sold Airbnb and Palantir because they are, quote, seasoned equities, unlike Robinhood and Rivian. Now, despite this interesting strategy, the Renaissance IPO ETF actually had a very good 2023 by gaining 53%, while the general S&P 500 index only gained 24% during that same time frame. So whatever this ETF is doing, it seems to be doing very well, considering that it more than doubled the returns of the general stock market. The senior strategist also noted that Airbnb originally went public back in December of 2020, and they were added to the S&P 500 in September of 2023. But what bothers me is, why would you sell Airbnb, considering how well the stock has performed if you got the stock at a bottom? For instance, Airbnb stock ended 2023 as a winner with a 59% gain. So Airbnb alone did better than the S&P 500 as well as the ETF, which Renaissance IPO has now excluded Airbnb from. But when we talk about Palantir, it gets even worse for them and better for us. That's because Palantir skyrocketed by 167% last year, far surpassing Airbnb, the S&P 500 index, as well as the Renaissance IPO ETF. So far in 2024, the rental company Airbnb and Palantir Technologies, which is a cloud software company, were up around 1% and 2.4% respectively. But I just don't understand trading Palantir and Airbnb for companies like Robinhood Markets and Rivian, considering that Robinhood and Rivian haven't really done as well as the other two companies. The strategist also commented about this by saying, as for Robinhood and Rivian, like other ETFs that are weighted by market cap, will typically purchase more shares of an existing holding due to improved stock performance in the recent quarter, leading up to the rebalance or a higher tradable float. But I don't think this is a good long-term strategy, considering that in the third quarter, Robinhood stock slipped by around 2%, while Rivian surged 46%. But for the full year of 2023, Robinhood did have a 57% gain, while Rivian shares surged by 27% in the last year. And so far in 2024, shares of Robinhood and Rivian have both lost around 14% and 23% respectively. So again, trading Palantir and Airbnb for Robinhood and Rivian was not a smart move. As of late, Renaissance has bought 93,707 more Robinhood shares in the fourth quarter to lift their holding to 429,386 shares. They also bought 87,975 shares of Rivian to end 2023 with 423,549 shares. And again, I can't stress it enough, I like all of the companies mentioned here, but I certainly would not trade Airbnb and Palantir for Rivian and Robinhood. Clearly, Rivian and Robinhood will need more time to mature, while Palantir and Airbnb are already bringing in major profits. So I really don't think this was a good trade by Renaissance. But I would love to hear your thoughts about this down below. And now we're going to move on to another another article with an AI stock that I absolutely love, and it's none other than Super Microcomputer, ticker symbol SMCI. This company was a top performing stock in 2023 that really did not get a lot of publicity, even though it brought in gains of 246%. Now, the good thing for me is that I was already invested into this company before the surge, but the best part is that they could still bring in impressive growth prospects for years to come. And that's the good news for you. They have already gotten off to a solid start in 2024 because the shares have already increased by 20% in the new year already. This company is clearly benefiting from the surge of demand for artificial intelligence, and while there has been no specific company news, the future of this company looks extremely bright. We also saw a surge in this company after Oppenheimer's recommendation to buy companies like Nvidia, Broadcom, and Marvell Technology, which are all great stocks in their own right. But a rising tide lifts all boats, and that's why Supermicro also increased in share price during this same time frame. If you didn't know, Super Microcomputer provides modular server and storage technology for various applications such as cloud computing, enterprise data centers, AI, and telecommunications. This company has multiple revenue segments, and they are actually achieving a large vein of success because of Nvidia. To add context, Supermicro released liquid-cooled rack scale platforms for installing Nvidia's H100 AI graphics cards. Essentially, Supermicro's liquid-cooled server racks could reduce power consumption in a data center by an estimated 40% when compared to air-cooled data centers. These data centers can become very hot, especially if they're using Nvidia's H100 AI graphics cards, so Supermicro can make this more effective and efficient in regards to cooling. The company even pointed out that they have its H100-focused liquid-cooled racks, which can reduce cooling costs in existing data centers by as much as 86%. So not only are Supermicro's liquid-cooled server racks more efficient by 40%, but they're also going to save these companies money by 86%, so it's a win-win-win for all of the companies involved. Because of this, Supermicro saw a massive jump in demand for their liquid-cooled server racks, considering that Nvidia has reportedly sold 1.5 million units of their H100 chips. Nvidia also anticipates that they will sell 2 million chips throughout the year of 2024, meaning that we should see more demand for Supermicro's cooling racks. More importantly, the market for artificial intelligence servers is expected to grow as well at an eye-popping rate. According to Foxconn, sales of AI servers can jump from $30 billion in 2023 up to $150 billion in 2027, which is great news for companies like Supermicro as well as Nvidia and AMD. As a result of this, it's not going to be surprising to see Supermicro increase in their overall demand and revenue. So let's talk about the hard numbers regarding their EPS and revenue. Supermicro currently projects revenue of $10 to $11 billion in 2024, which would equate to a 49% jump from the previous year. But what's even better in my opinion is that they are projecting a 46% increase in the company's earnings as well, considering that they're going to bring in earnings per share for the full year of $17.28 per share. And honestly, I think that's why investors should consider buying this company. Even fundamentally, the company is trading relatively cheap in regards to their accounting ratios. Right now, the company is trading at just 2.6 times their sales, and their PEG ratio or PEG ratio is 0.94, which is below 1, making this company a phenomenal value right now. Honestly, the company is undervalued right now, meaning that investors should jump on this opportunity before it's too late. Supermicro stock won't stay this cheap forever, and that's why I want to make you at least aware of this company, but the buying decision is up to you because you need to make sure to do your own research and practice proper risk management when evaluating a company. But I would love to hear your thoughts about any or all of these stories. Go ahead and annihilate that like button right now, subscribe if you are new, comment your thoughts down below, and with that being said, I will see you in the next YT video.